Hey guys, and welcome back to the channel. And today we're going to be doing something slightly different with the top three trend doing really well on my channel. I thought, you know what is the top three UK retail stocks that I think you should buy and hold forever in your portfolio? As always, this is not financial advice, it's just for education and entertainment purposes only. Please do your own research, invest based on your own circumstances, and remember, investing involves risk. And past performance doesn't guarantee future results. And as I say, all what I show on my videos is what I've learned personally, and I haven't even learned probably as much as the best people in the world. Basically, I'm still learning every day. So any feedback that you guys give, I also put that to the test and into my notes as well. So please comment down below if there's anything that you think I should improve on. But let's get straight into it. So as we can see, you wouldn't be surprised that Tesco's is the first company on my list. This has already featured on my channel before, and it's a company that I've actually added and holding at this moment in time in my portfolio. And honestly, I shop here all the time. Like I do, because especially with the Tesco Club Card prices, they are very much hard to beat. Now, even with the Club Card, and probably there's places out there you can get them cheaper, but for the Club Card, it feels rewarding to get the points. I don't know, just for me, every time you get something that you can collect points on, I go there. Don't know why, it's just satisfying to see the points grow and grow and grow. And they go into vouchers, which you can get money off your shops. And of course, when you look at Tesco's website, you instantly see what makes them so dominant. You know, you got the groceries, you got clothing, I think it's Fraser and Fraser. Um, I forget what the brand is. Home goods, banking, mobile, and even Brooker, which supplies restaurants and corner shops. Now, Tesco's isn't just a supermarket, it's a full ecosystem in itself. They operate in the UK, Republic of Ireland, and Central Europe, and they've built a retail machine that's incredibly hard to compete with. Now, Tesco's has been a slow and steady compounder, as we can see in the year to date. It's actually just below 6% up the year to date. A year ago, it's up by 23%. 5 years ago, it's actually up by 107%. And 10 years ago, it's actually up by 190%. It's not the fastest mover, but incredibly reliable over the last decade. This business has stabilized margins, improved efficiency, and strengthened its balance sheet. Now, Tesco pays around 3.1% dividend, and while it's not huge, it's consistent. Now, Tesco's dividend is like a quiet little snowball. It's small, but it keeps on rolling, and over time, by the time it's like you're at your 40s, it'll be the biggest snowball that you've ever seen in your whole wide world. And earnings have been improving thanks to strong grocery demand, better cost control, the Save to Invest program, and their wholesale growth. Now, of course, Tesco's generates strong free cash flow, which supports the dividends and buybacks. So, why does this stock go up and down? Well, Tesco's moves based on a few things. You got inflation in food prices, consumer spending is either up or down, competition from Aldi and Lidl, fuel prices because they also sell gas or diesel and petrol in their gas stations, interest rates affecting household budgets. Now, when inflation cools, Tesco's often benefits because shoppers trade down from premium brands to Tesco's own label products. And especially their cornflakes, I love them to pieces. I used to be a big fan of, I think it was Keller's, the one with the, is it the chicken or whatever it is? I think it's not a chicken, but it's kind of like, it's a rooster, or whatever they're called, with the cornflakes. Well, I used to be a big fan of them, and I used to be picky, and every time Mum used to come in and go, "Oh, I brought you these," and I was like celebrating. And then one day she got the Tesco's own cornflakes, and I blew up. I was like, "No, no, no, no! You can never put your back behind them." But then I thought, you know what, might as well give it a go. And ever since then, for the price as well, they pretty much taste the same. I know how bad that sounds, but they pretty much taste the same. So that is why Tesco's own label products do beat sometimes against other products. Now, of course, there is very much big risk in UK retail at the minute, with the tight consumer budgets, high competition, rising wages, supply chain costs, and economic uncertainty. Now, for the Tesco specific risks, that is probably from the heavy competition from, like I say, Aldi and Lidl, the thin margins in grocery, exposure to fuel prices, and regulator pressure on food pricing. because a lot of the minute are complaining at the government, and the government are complaining at them to cap prices in certain foods. I don't see that ever happening, but there's always one to look out for in the future. So, what to look out for then? Well, same store sales growth, margin improvements, wholesale performance, cash flow, dividend coverage, and buyback announcements, especially the last three, which Tesco's are very much good at. Now, for me, why did I add Tesco's to my portfolio? Well, it's a forever stock because, in my eyes, it's stable, essential, and cash generative. People like us need food in every economic cycle. And I already hold Tesco's in my portfolio, and because I shop there quite regularly, I kind of understand what Tesco's is about, and because I shop there and I kind of understand like what people are buying and what they're grabbing. If people are grabbing Tesco's own products, then you can see that there isn't much money to be used in the shops. But it's not flashy, but it's reliable, and that is why I added it to my portfolio. And the next one is, in my opinion, one of the most well-run retailers in the UK for the last, I think, 10 years, I think it's been. And, I think they're going to keep on going. And when you look at their website, you will see exactly why. They're very much a clothing brand. Clothing for men, women, and kids. They also do homeware, beauty, furniture, holiday shops, brands, gifts, and sports. And trust me, I have had many neck sofas delivered due to my mum. My mum loves their sofas, and to be fair, they're the most comfiest I've ever sat on. And Next is basically the UK version of premium department stores, but online as well. They also run Next Finance, Next International, Lipsy, and a huge online marketplace. Now, Next has been one of the best performing UK retail stocks of the last 20 years, so the share price has grown massively because the company is extremely well managed. Now, Next also pays a dividend of around 2%, but historically they've also done special dividends. So if anybody doesn't know what special dividends are, it's when the company does really well, better than they actually think, and they offer money back in either buybacks or they give you an extra dividend alongside the original one. So that's how special dividends work. They also return cash to shareholders when they don't need it, which is a sign of disciplined business. Now, as you can see, year to date is down by 4%. A year it's actually up by 4%. In 5 years it's actually up by 65%. In 10 years, 145%. Now, once again, like Tesco's, it's very slow, very steady, but in my eyes, very reliable. It's not your flashy Microsoft or Meta stocks. Now, Next consistently delivers strong earnings thanks to high online sales, strong brand loyalty, efficient logistics, good cost control, and they're very profitable in the finance arm. Now, they're one of the few UK retailers that actually grow during tough times. The stock goes up and down due to the clothing demand, consumer confidence. You're probably going to hear consumer confidence quite a lot, especially nowadays, especially in these few months that have been and are going to come. Online sale growth, seasonal performance, and inflation affecting clothing costs. So basically, the inflation is affecting how much Next can buy in terms of clothing, in terms of the suppliers. And when the UK economy is stable, whenever that will happen, Next usually rallies. Now, when consumer budgets tighten, the stock can dip, but it often recovers very quickly. And to be fair, I'm not quite sure what the government is going to do. We don't know what the government's going to do in the future. So, if the revenue and all that keeps growing and the cash flow generations and the fundamentals of the stock keep going, no matter what happens with the government or the inflation or that, the company will probably come out better in the long term. Now, there is risk, like I say, in a lot of the UK retail at the minute, and especially with Next, they aren't away with it as such because they're in the clothing industry. So fashion trends change quite a lot. The high return rates because people may not fit in the clothes they've ordered. They think they might be a small, but they're actually an extra small. Or, for example, like me, there's some brands that I can fit in a small, and some brands I have to actually buy a medium. So, of course, I do get a return rate, and of course, they do actually. Some companies, I think Next do as well, actually pay for your return, so you don't actually have to pay it yourself. And of course, at the moment in time, this is a big day where there's a lot of competition from like Zara, H&M, ASOS, but also Shein and Temu. A lot of people talk about these Sheins and Temu. I don't shop on it. My partner shops on it. I don't really see the big obsession of Shein and Temu. Yes, you get products for like £1 or £3, £4, but the quality, in my opinion, is not that great. She says it's good because she can use her clothes, like dresses, for example, on a one night outing, and she's only paid £4 for it, so it can go in the bin the next day, or it can be recycled, and so on. But for me, I like to buy brands that could last, so that's why Next comes involved. Pay a little bit on the expensive side, but for me, it's the brand loyalty and the good brands that they sell. Now, with Next, they do have a high specific risk, and that is season volatility or volatility. I can't speak English sometimes. I do apologise. But that is basically because the fashion trends keep changing, and when it comes summer to spring, a lot of the fashion goes out. So the summer stuff comes out, spring goes in, and winter stuff comes in as well. So it goes on, and the cycle just keeps changing. But what should we look out for Next? Well, you've got online sale growth, profit margins, inventory levels, see if they're actually selling their inventory, what the return rates can be, international expansion, how the finance section is doing. Now, if I were to add Next into my portfolio, it is a company that I do shop regularly, so I do understand what the customers are looking for and what Next do really well in and what they do need to improve on. But if I was to add it to the portfolio, it would be because it's a high quality, well run retailer with strong cash flow and a long track record of rewarding shareholders. And for me, if that's what's going to be added to my portfolio, that's good because it's kind of a business that compounds quietly in the background. And lastly, it is Marks and Spencer's, a classic British retailer that the website exactly shows what they are good for: clothing, food, home, beauty, flowers, gifts, brands. And they've even got a partnership with Ocado. Ocado? I never know how to say them, but they're like the delivery company that went really good. If anybody was investing back in, I think 2023, they shut up to 1,000 GBX and then they crashed all the way back down again. But they're quite good in terms of what they do, and it's just that it was like a meme stock in 2023. That's how I remember them. They modernised massively in the last few years, and the turnaround is finally showing results. And my mum is quite happy with that because she actually is a regular Marks and Spencer shopper. Don't ask me why. I always walk in that shop, and yes, probably the air conditioning is probably the best thing for them. I don't understand how the layout attracts people. Like 1 minute you're shopping flowers, next minute you're shopping in the bread section, and next minute you're in the frozen section. There's no layout whatsoever. But that's just my opinion. That's my local Marks and Spencers. You might have differently. But for a company overall, they're actually quite a good company at the minute. They're just in a little bit of a stick, a little bit of a rut. And I think their turnaround is finally showing the results, like I say. They have had a rough decade, but the turnaround has been slightly impressive. Their share price has recovered, and a business has modernised with that. Now, they did pause dividends for a while, but they're now paying around 1.2% now. It is a small, but it signals confidence. And earnings have improved thanks to their strong food division, their better clothing range that has improved, their improved online presence, as we can see today. They have cost cutting, and of course, their partnership with Ocado has actually quite helped. Now, food is the main reason why they're actually doing quite well in their turnaround play, because their food is a bit of a star performer. They're actually going for high quality, high margin food. Yes, they're going for like these pots or like watermelons and pineapples. They actually cost about £5 to buy. Well, they were when I went to go shop a few weeks ago to just do my research on terms of what they are selling and what they are really going for. And this is why I put their food is more pretty much high quality, high margin stuff. Now, of course, I don't regularly shop, so please do your own research at Marks and Spencers if you want to know what they actually shop for. But why did this stock goes up and down? Well, it's pretty much the same as Next and Tesco's, but a little bit of a combined. So clothing performance could go up and down. Food sales, turnaround progress could fail or could falter. Consumer spending, and of course inflation in both food and clothing. When Marks and Spencer show progress in clothing, the stock also usually jumps as well because they're also judged on clothing quite as much as they are on food. Now, the risks in the retail, especially, like I say, is competition from the supermarkets like Tesco's, Lidl, Aldi. The fast fashion pressure, because the fashion changes, like we say in Next, economic downtowns, and the high operating costs at this moment in time. Now, the specific risks that come with Marks and Spencer's is the turnaround could stall, clothing trends could shift quickly, their partnership performance with Ocado, and a high cost base. But for me, for this to look out for is clothing and home growth, food margins, online sales, profitability in their partnership, the dividend growth, and see if they can grow it back to the way they are, and can they pay off a bit more of their debt. Now, why would I add Marks and Spencers? Well, if I was to add them to the portfolio, it would be because the turnaround is actually working. The brand is strong, the food division is elite and high margined, and clothing is improving every year. It is a stock with huge potential if the momentum continues. So, as you can see, the stock, as we can tell, is in 5 years up by 132%. In a year, it's actually down nearly by 7%. Year to date, it's actually improved nearly at 9%. So, as you can see, the turnaround, I think, is doing quite well indeed. Still 14% off 10 years, and it's actually 13% off its all time highs. So, I think it's all time highs or all time performance. So, as you can see, it is slightly improving and getting there. So, if you do want to judge it off what they're doing, I would recommend waiting for the next earnings to see if the turnaround play is still going as well. But that is basically my top 3 UK retail stocks to buy, hold, and forever. Those, once again, that's Tesco's, Next, and Marks and Spencers. All 3 are strong brands, cash generative, and part of everyday life here in the UK, in my opinion. Like I say, I hold Tesco's already, and I do shop regularly at Tesco's and Next, so I understand these from the customer side, but as well as looking at the fundamentals as an investor. Now, if this video does hit 10 likes, I'll make another deep dive in a different industry sector that you guys comment down below, and make sure to follow and hit the subscribe button, and I'll see you on the next one. Goodbye!